we could discuss more on the outlook and the financial performance as well. Well, time to move on then. Metro Brands, that's the next corporate on our radar. The company reported a rather good set of numbers. Solid revenue growth in Q3, while margins as well were stable. Although their profit after tax was impacted, but that was on account of higher depreciation. To discuss more on the past quarter's numbers and the way ahead, well, we're joined by Mr. Nissan Joseph, this Chief Executive Officer who joins in. Hi, sir. Morning. Thanks so much for joining in. Well, congratulations on a good showing. The street has read these numbers positively. But you'd like to know a couple of numbers. One being, what was the same-store sales growth for the past quarter? If you could give us a sense of that. And also your gross as well as your EBITDA margins looked quite good for the past quarter. Do you expect to maintain these levels going ahead?
All right. Well, good morning, and thank you for having me this morning. Just to give you an answer on the same-store growth, we do not disclose those numbers. Having said that, though, I think any retailer today needs to target inflation plus 300 to 400 basis points, and we're well on track to hit that number internally, and we are very comfortable and excited about where we see our comp store growth going. So that's number one. And to answer your question regarding gross margins, we've always guided to 55 to 57%. Obviously, last quarter was also higher than that at 59% gross margin. But we're very comfortable knowing that we want to attain the 55 to 57% gross margin simply because we believe that that's the price point at which, that's the margin rate at which we can offer the best value to a consumer on a steady basis that we can continue to do so. So that's number one. And we always guided on our profits that, we believe that we can be between 15 and 17%. Obviously, last quarter was also higher than that. But those are the targets that we try to achieve simply because we think that allows us to position ourselves to have sustainable growth without putting pressures that become unrealistic and in some ways might increase pricing. And in the fashion world, you can increase pricing one quarter, but then you'll turn around and take markdowns the next quarter. So we want to have a very steady keel at a very steady hand at the keel for this business.
Sir, we wanted to ask you about that 15 to 17%. I think you're talking about the net profit margins, right? When you're guiding. We wanted to know, what about the EBITDA margins? For the past quarter, it was at around, upward of around 30%. So what's the outlook out there? 34.3% is what you delivered in the past quarter, EBITDA margins.
And thank you for that. What we also guide to there is typically from the low to the mid 30s for EBITDA. That's a number that we've achieved for a number of years, and that's a number we zone in and want to achieve on an ongoing basis while keeping our growth rates continuing to be high.
All right, got that. I want to talk a lot about how your e-commerce sales have picked up in a big way, and this is the highest ever quarterly e-commerce sales. But before I ask you that, are you on track about your store opening target? I mean, you had a target of 260 store openings in the next 3 years. How much have you done up until now, and what's the expectation in the next 3 years?
So in the 3 quarters of this year, we've exceeded 90 stores, Sonia, in growth out of the 260. So the math extrapolation would be we're ahead of target on that. And that's a number we're comfortable with. We guided to 260 stores, as you mentioned, and we're very comfortable we'll hit that number. So there's no risk on us not achieving that number at all.
Okay, so there's no risk. You will achieve 260 store openings in the next 3 years. Tell us a little bit about what's happening with e-commerce, because you've done 50 crores, which is, I think, your highest ever quarterly e-commerce sales. How much would the e-commerce space contribute as a part of your total business in terms of a percentage contribution? How much do you think it could go up by over the next 1 year? And what are you looking at in terms of a quarterly run rate?
Right. So I think there's a couple of things here that I want to speak to. One of that is that last quarter was the first quarter that we had that's what I call a normalized quarter, right? So for years, we've been comparing it to current year -2, -1 because of COVID impact, right? So we were able to compare our numbers to last year, where the markets had opened up and people were back shopping again, right? So that was very positive for us. Last year, at the same time, you asked me if there was pent-up demand. You asked me if there was wardrobe refreshes. And I think we had all of those happen in Q3 of last year. And the great news is we've comfortably come ahead of that in Q3 of this year. So that's number one. While doing so, our brick and mortar stores have come alive very rapidly and very excitingly. But we've also noticed it has not come totally at the expense of e-commerce as our e-commerce continues to grow. we believe that digital sales are critical for a company. At the same time, you've got to watch that they don't in any way diminish your brand or erode your brand. So we right now are at 8 to 10%, and that's a number we're comfortable with simply because we believe our consumers, especially in the footwear space, like to touch and feel shoes as they buy them. So they're going to lean and be more inclined towards shopping more in a store environment, which is great for us because we have a lot of them out there. But it doesn't mean we're going to walk away from e-commerce. We're going to continue to want that channel to grow at or better than the rate of growth for the entire company.
Mr. Joseph, but you're saying e-commerce is 8 to 10%, and you want to keep it that way. I mean, wouldn't it be better if that grows substantially? And I mean, that would mean lesser number of stores. I mean, you need stores to service this demand coming through the digital channel, but not so much if, the proportion increases, the e-com proportion increases. So, yeah, go on.
So what we look at it is from a profitability standpoint. We have deep financial discipline at Metro Brands, right? And I think if you look across the landscape, there's not many companies that come in with the profitability of us, definitely not in the e-commerce space, right? So when you look at that, you would ask me, why would you want to grow e-commerce if it's not as profitable as the rest of your business? Having said that, though, we're totally aware that the consumer is digitally savvy and expects you to be online, expects to have a digital experience, but it's really more about a 360 experience for the consumer. What we find is they're doing a lot of offline to online, simply because they want that journey. They start their journey online, but they finish their journey offline. So while we may not want to see digital sales specifically grow to a target number, it does not undermine the importance of digital in our portfolio. But I also think it underscores the importance of brick and mortar in our industry.
No, so is the e-com strategy? I think other footwear companies like Bata, etc., also do that. They don't stock all their products across stores in every store, but they are able to give you a sense of, and then you kind of you see what you like, and then you order online. Is that broadly the way that you were looking at e-com as well?
Yeah, the part about e-commerce that excites us most is what I would call the omni-channel business, which is what you're referring to, where customers can see my entire breadth of inventory, and then they can have it delivered to their houses very quickly because we ship it from the nearest zip code. So that is a very exciting proposition for us. What does not excite me about e-commerce is, and you find that people that start getting into the high double-digit ranges also do so with a lot of discounting, and we're not in that game. We're here to provide customers value at a premium price.
All right, Mr. Joseph, very quickly, you've given us most of the numbers. So the stock is at the high point of the day as we speak. Last year, you did around 1,350 crores. This year, you're going to end in that vicinity of around 2,100 crores, just trying to extrapolate numbers. But on whatever you finish in FY23, what kind of a growth you're looking at for FY24?
So, we've maintained a CAGR growth of over 17%. Right now, our CAGR has jumped up because of the last couple of quarters. Yes. Metro is one of those that believes to have a steady business going as opposed to, have peaks and valleys. So it's not like we target to say, let's get up to a 30% growth or a 40% growth at the same time, turn around and have a year where we don't have any growth. It's about having a steady, double-digit growth maintained for the many, many years.
So high teens.
That's definitely something we would be doing, yes.
Okay, all right. It's been good speaking to you, Mr. Joseph. Thanks so much for stopping by. Your stock is at the high point of the day. It seems the street likes what you just said. So the numbers go on with a thumbs up. For the time being, the markets as well are doing pretty well. We'll slip into a short. We'll come back. We'll get our technical experts back with us.